Well, good afternoon and welcome. Welcome to another of our series of Wednesday webinars and also the Brown Bag webinar series offered throughout the Central California region. Well, good afternoon. I'm Kelly Bearden. I'm the director of the CSU Bakersfield Small Business Development Center, and I will serve as your moderator today. Today I am in beautiful Mono County at the home of the Mammoth Lakes Brewing Company is where I will be today. Our presenter, Jenny Inholm, will be at her place of business in San Luis Obispo. So that is where the two areas where we're going to originate from today. I promise you, being at Mammoth Brewing Company, I will be in the presence of great beer, but I will not imbibe. So on with today's show. The webinar today, I think, is a great topic. It's cash flow that affects everybody, every small business, successful, non-successful, and it's really a topic that is really near and dear to my heart. So moving right along, the SBDC program is a national program, as many of you know. We're in all 50 states, and in California, we're part of the Central California region, which is a 14-county region which is identified in Central California from the coast to the Nevada border, far south to Kern County to the upper northern regions of Mono County, cutting out 14 counties. We serve 3 counties, and today, as I mentioned, I am up in Mono County working with businesses up here, so it's a pleasure to join you from up here. Your interaction today with the webinar, is please think of questions and ask questions. We will take them at the conclusion of the webinar. Everything that you can think of that want questions for, please come up with at that time. And to open up the question box, all you do is go down to your dashboard to where it says questions, and please click on the right-hand arrow. At the end of our presentation today, we're going to float a survey out there. We're looking for your input, and also, as we do more webinars in 2018, we're looking for topics that you really want to have and want to be heard. So please use that as an opportunity to put in some topics that would be good webinar topics for 2018. Handouts for today will be available. Just mention in that survey that you would like a handout, and we will get those for you. So many of you know what the SBDCs do, but we provide high quality, no cost, confidential, one-on-one consulting. And that's really kind of our wheelhouse that we work in, with trained senior level consultants in a number of our centers throughout the region. We have centers at the CSU Fresno, in the Modesto area at the Valley Sierra SBDC, the CSU MB SBDC in Salinas, and also Cal Poly in San Luis Obispo. So we have a variety of senior level consultants and also junior or associate consultants in many of those regions, and offer a variety of different programs and classes. As many of you know or are already doing, EDD is invoking mandatory e-file beginning in 2018 for businesses that have 10 or fewer employees. So if you're not e-filing and e-paying, you will need to do that in order to avoid costly and unnecessary penalties in the future. So a lot of resources to help you there. You can connect with your local SBDC. With our SBDC, we're at a variety of different social media channels and networks, a lot of different ways to connect with us. Our next webinar that's coming up is going to be on a great topic as well. It's going to be on leadership tools to take you into the new year. And I think we're going to have a great webinar coming up in just a couple of weeks. So that brings us to today's webinar, and we're really fortunate to have Jenny Inholm with us. And before I introduce Jenny, I'm going to kind of gauge our audience on what you've done so far along this topic, and by floating a couple of polls. So the first poll I'm going to launch is going to be, how skilled are you at managing cash or budgeting? So you can select one of the following. I'm not skilled at all. A little, but I need more tools to help me. I'm pretty good, but I need to get better. Good, looking for newer techniques, and very skilled. I manage cash flow on a routine or daily basis. So the poll is now open. Please jump in and give you enough time to vote on this. We've got about 75% of you voted right now, and the majority of you, the slight majority, you know a little bit but need more tools to help you. So I'm going to give you 2 seconds, and I'm going to close this poll, so vote if you get the chance. Okay, we'll close that poll, and we'll share the results with you. And half of you, kind of really decisive numbers here, half of you actually are a little skilled, but you need more tools to help you. The other half of you are pretty good or good. So that's great to see. We have one more question, one more poll for you. And that one is going to be, and you can select one or more of the following. Which tools do you use to budget or manage cash? And we have 4 selections here for you. As far as tools to use to budget or manage cash, do you use accounting software? Maybe you use Excel, an Excel spreadsheet, standalone budgeting or accounting, or actually standalone cash flow software. Or you use manual tools, paper and pencil, and you reconcile accounts and keep a tab that way. So again, give you a few more moments to do that. And what we will do is 92% of you voted. We will close that poll, and we will share. We're going to have a poll this time, since you could have selected multiple topics. Most of you are using accounting software and Excel. A few of us still use those manual tools, paper and pencil, good old paper. So that's a little bit about who is in attendance today. So I'm going to hide these results, and what I'm going to do is I'm going to introduce Jenny Inholm. And Jenny, as you can see by her bio that's on your screen, is a CPA, and with over 30 years of experience. She started with one of the big CPA firms and has relocated to San Luis Obispo. She has joined Cal Poly faculty in spring of 2013. Currently a CPO of a small business. I think it's a small business. It's a wine transport conglomerate. You see conglomerate and small business not every day, but she also serves as a financial consultant for the Cal Poly Small Business Development Center and for the Center of Innovation and Entrepreneurship. I will let her tell a little bit more about herself. Jenny, it's great to have you. I am going to give you the controls and let you take over. So Jenny, great having you today. It's a pleasure to have you talk about cash flow at a time when we're winding up basically 5 years of doing webinars. So Jenny, take it away.
Thank you, Kelly. Appreciate the introduction and the polls. Great to know what people are, where they're coming from. So we're going to talk today a little bit about cash flow and how to know what's going on with your cash balances. We don't want cash to be a mystery. We don't want to run out of cash. We're looking for early warning signs of cash trouble, and so that we can focus on running a successful business. We have lots of things going on. We've got vendors to deal with and customers and employees. We don't want to run out of cash and have that be a surprise for us. As Kelly said, I am a CPA and a chartered global management accountant. I've been a financial executive for over 30 years and everything ranging from Fortune 500 companies to startups. I've owned my own manufacturing company for about 10 years, and I am currently, yes, it is a small conglomerate of a national trucking firm. We've got about 3 locations throughout the U.S. and deliver primarily wine everywhere we go, which is nice too. Not quite as nice as the beer place, but oh well. I am a lecturer at Cal Poly, and I'm also the consultant at the Cal Poly CIE SBDC, excuse me. All right, so let's talk a little bit about managing your cash. What is the mystery of cash flow? Well, the mystery is, where does it come from, right? Where does it come from? Where does it go? Why does it always go? And why doesn't profit equal cash? I get asked that question quite a bit. Cash primarily comes from customers. That's really where we want it to come from. That is the least expensive, least invasive way for a company to obtain cash. That's what we're supposed to do. Our business model should make us cash. Other than that, we can get cash from investors. Investment money isn't expensive usually, but it does mean we have to give up part of our ownership of our business. And that's, we have to be careful with that because it's little by little, you raise money over and over again, you give away more and more of the business, and all of a sudden you no longer own 100% of your business or even control your business. And lastly, lenders. Lenders are usually primary senior lenders, such as banks, can get a lower rate of interest than, say, some of the outside mezzanine type lenders. But any lender, you're going to have the problem of having a repayment schedule that you have to adhere to, and you're also going to incur that interest expense as they charge you for borrowing their money. Cash goes to a lot more places. If we don't pay our employees, they probably won't come to work anymore. We can't provide our services. If we're not paying our vendors and suppliers, they may put us on COD, cash on delivery, or stop working with us altogether. Our landlords or mortgage lenders can kick us out of our facilities or foreclose on our properties. Investors, if we're paying them back or giving them dividends, and of course regulators. There's a lot more funds going to compliance now than there used to be. 10 years ago, there was not nearly so many agencies with their hand out looking for permit money and advance payments for different things that we need, including all the way up to taxes. So cash goes a lot of places, as we all know. Forecasting cash can help us make cash decisions a lot easier. We forecast based on an estimate of the future as well as an analysis of the past. By doing this, we can estimate how much cash we should have on hand. We can estimate how much it'll cost us in cash to accept an order. Will it cause a cash flow problem? I work with quite a number of food companies down here in the San Luis area, and they need to get the cash to buy the ingredients to prepare their food product to sell to the vendors. So while it might be great to get that huge order from Whole Foods, it's going to take some cash to get that product to market, and then you're going to have a timing issue between getting the product to Whole Foods and getting paid for it. So you need to understand what that does to your cash flow. Sometimes we have equipment or machinery that we have to purchase, and can we afford that repair and maintenance? What is that going to take? Do we even think of those things? Forecasting makes us think of potential issues we may have in the future and recurring cash decisions. And lastly, can we respond to any opportunities or just unfavorable circumstances? Customers came on slower than we thought they were going to. Customer pays slower. A key customer goes out of business. All these things can cause our own companies to have unexpected cash flow problems. So a couple of things we're looking at in forecasting in particular is, what's our burn rate? If we're losing money, we want to understand how quickly that's happening and how long we have until we run out of cash. And that is also known as the runway. Those are two very similar terms. So we're looking at how quickly, how much time do we have to execute our plan to get cash flow positive. So the first thing we need for cash controls, we need to have good accounting records. We need to have good numbers in order to make good decisions. All accounting is there to provide information for business owners to make good decisions. And it's a little bit of garbage in, garbage out. There's a lot of different accounts on an income statement, for example, and not quite as many revenue as expense accounts, unfortunately. But if your accounting team or yourself are not consistent in where you put your numbers. Sometimes we use the repair and maintenance account. Sometimes we use the auto account. We're going to make some decisions maybe that aren't quite accurate. So we want to make sure we have consistent recording of transactions, and Um, One thing we can do is organize our chart of accounts to help make our numbers more meaningful, and we'll talk about that a little later. You know, we have to understand those financial statements tell a story. They tell us if the business is healthy. So we really want to put a priority on good accounting records. So many small businesses do not do that. It's sort of like the also ran. You know, yeah, I have a bookkeeper, I pay him $12 an hour, or, you know, my sister does the accounting or whatever. Yeah, well, your records may not be as good as they could be. Maybe, maybe not, but we should take a look at that. A biggie for me, it's really critical, bank reconciliations. We should be doing monthly bank account and credit card account reconciliations. Even if you do a bank download, a lot of the accounting software like QuickBooks Desktop, QuickBooks Online, they have the ability to download your banking transactions. You still want to do reconciliations. I had a client once that sold at the farmer's market, and then she also had some wholesale clients that she sold to. So for her wholesale clients, she wanted to send them an invoice because she gave them terms, and they paid her in 30 days-ish, right? So she wanted to send them invoices and understand who owed her money and then record when that customer paid her. Her farmer's market business, on the other hand, was really just a cash business, and she didn't really want to track all that. Well, she was using bank downloads to do all that and was not doing bank reconciliations. So when it came time to fund some inventory that she needed, she found out she was missing about $8,000 in cash. And what happened was we were duplicate recording of transactions. So in other words, the bank download was recording a deposit from farmers market clients and the deposit from the corporate client. She was also recording the deposit from the corporate client when she recorded the received payment against that invoice in QuickBooks. So the duplication of those deposits made her believe that her cash balance was higher than it was. And then it sort of became like, oh my gosh, I have to deliver this product in 30 days. How do I do that when I don't have the cash to purchase the inventory? So we don't want to have those surprises. Doing those bank reconciliations every month, again, critical thing. It's the only way to know that everything that's supposed to be in the accounting system is indeed in the accounting system, and everything that's not supposed to be in there is indeed not in there. One last thing on bank, actually two last things. One is old items in a bank rec. I had somebody tell me the other day, oh yeah, we've been doing our bank recs, we're all caught up, everything's great. I said, okay, good, let's take a look at them. And they had items in there still open from January and February and March, and this was in October. And I said, well, you really shouldn't have these old items open. Now, perhaps there's someone you wrote a check to and they haven't cashed it yet. That's one thing. But ACH payments and any other card payments, debit card transactions, those clear very, very quickly. So we shouldn't have any old outstanding items on our bank rec. And then lastly, that bank reconciliation, important to have a separation of duties. This is one of the most basic internal controls. The beauty and horror of something like QuickBooks is you can go back and fix anything. Well, if you're a bookkeeper trying to take a little cash out of the business, it's really easy to write a check to yourself and then go back in and record that that check was really to a different vendor. So you want to have what's called separation of duties. And the bottom line on that one is whoever's touching the assets of the company should not be the same person who's recording those transactions related to that asset in the accounting system. And that can be whether it's cash or fixed assets that you have or inventory. Anyone who has the ability to actually touch the physical product and account for it in the accounting system, make transactions in the accounting system, they have the potential to create a fraudulent transaction. So I want to watch those separation and duties as a major cash control. And lastly, on cash controls, don't spend it unless you absolutely have to. That's a really good way for entrepreneurs to think. I've heard before, a good entrepreneur only spends money if they absolutely have to. You don't want to wait till you're about out of cash to figure out how to control your expenses. You want to always have that mentality of control what we can. All right, so as I said early on, we use a couple things in forecasting. We use historical information as well as our estimates of the future. So the historical information is going to come from our financial statements. They say what happened. Financial statements do tell a story. They're saying where we've been and what our trends are. So let's take a look at a typical income statement. What we see here is an income statement, also called a profit and loss statement. This tells us, is the business profitable? And from it, we can gather why or why not. I like this format of comparison. We have one column that's year-to-date actual, and the other column that's last year-to-date. In practice, I'll use monthly trends and actually look at a 12-month P&L, which a lot of the accounting software reports do very nicely. And I also like to have that percent of sales column because that helps me understand what's really going on with the trends. So first, let's look at the organization on the left side of the accounts. This is very important. Sales always comes first, of course, but then we want to have our cost of goods sold. If we sell a product, whether we resell a product or manufacture a product, we will have cost of goods sold on our P&L, our income statement. Cost of goods sold represents all the costs of the product itself. Nothing to do with selling the product, only the cost of the product itself. That's because sales less cost of goods sold equals that gross profit number. That tells us something. That tells us what our profit on our product is. If we're buying water bottles for $1 and selling them for 75 cents, we don't have a profit model. We have a charity model, right? We're going to have a negative gross profit. So we want to make sure we have gross profit on our product. That's how we pay for all of our other operating expenses. If we look at the gross profit percentage, and everything again is a percent of sales for the same year, the $7 million of gross profit is 45% of the 15 and change million net sales for the current year. Last year, we had a 49% gross profit. That's a huge switch, a huge decline. A little over 4 percentage points is a big drop in gross profit, especially since there's only two numbers in there that matter. One is our sales prices, and the other is the cost of our product that we sell. So if that number is moving around a lot, which is, and I think anything over 2% is a lot, we should understand as managers why. Why is that moving? Did I have a temporary reduction in my sales prices, maybe to gain market share? Or do I have a permanent reduction in sales prices and I need to now work on my costs to get my margin back up? Or do I have a increase in my costs? Maybe I switched suppliers or had a supplier increase costs on me. I want to make sure that I figure out how to control those costs, how to get those down to maintain that gross profit or my profit margin. Always want to have at least 2 suppliers for every product or every major product that we need. Things happen to people from natural disasters to internal disasters, and so we want to make sure our business is not affected by someone else having an issue. The next category we have is the sales, general, and admin expense. This is all of your selling costs, selling commissions, the freight costs to get the product to the customer, any general HR, legal, admin, IT, all of those expenses, executive salaries, they're all in that next section, which become part of operating income. So everything it takes for the day-to-day operations of our business is in that sales, general, and administrative section, and then we have an operating income. And as we can see from this income statement, our operating income is 12.5% this year, and last year it was 10.5%. So we go, hey, great. our operating income is getting better, but we still want to understand why that gross profit is down. And if we look at our sales, general, and admin line item, we can say, hey, yeah, our selling costs are down about little over 6%. That's why our operating income went up. And then we can ask questions like, is that sustainable, right? Will it hurt future sales? Did we just reduce all our sales commissions in order to reduce costs, and maybe now we can't get as many sales next year and we're going to be in trouble? So we want to understand why we are seeing the trends that we're seeing. The next section is your other expenses. Notice that these are categorized on purpose like this. Do we make a profit on our product? Gross profit. Do we make a profit on our business as a whole? Operating income. And then lastly, do we make a profit overall? Net income. And out of that, it's things like interest, let's say you have a vehicle you no longer need in the business and you're going to sell it, and you either lose money or make money on that sell. That's not your primary business. So any gain or loss from that kind of transaction would be an other expense. Interest you pay on debt for the company is going to be down there and other. Why? Because it's not part of your day-to-day operations. I had a client once who had their income statement in alphabetical order, and I is pretty high up in the alphabet, and they continually were losing money every year, 5 years of losing money. And I said, well, let's rearrange your income statement into this format so we can understand the story and we can try and forecast how to get you out of this mess. And when we looked at it, sure enough, yes, they had gross profit, so that was good. They were selling a product. Then we looked at operating income. They did have operating income. What they had was an exorbitant amount of interest expense, and it turned out they were paying 25% interest to friends and family for interest expense, which is obviously very high. So we were able to repackage this income statement format for a few years, take it to a bank, and show them how if we could refinance at a rate of 6 or 7%, the company could indeed be profitable and afford to pay back its debt. So that was important to help that company get back on its feet and refinance all that debt. So these trends in these numbers and the format of the P&L are so important and help us answer questions and ask questions about what's going on with this business. The other thing I hear a lot is, I had profit on my income statement. Where did the money go? Why don't I have this much cash in the bank? Well, maybe you paid back some debt. Principal portion of debt repayments is not on that income statement. Maybe you bought some capital assets, some machinery, some equipment, some vehicles. Maybe you have some deposits that had to be made, or prepayments of insurance, for example. Unearned revenue, deposits that customers give to you that you have not yet earned. You really want to keep track of those separately. You haven't earned it, it's not on the income statement. The income statement represents revenue we've earned and expenses we've used. So things that we have not yet earned or used, we would put on the balance sheet. And then also accounts receivable and accounts payable. Changes in those numbers affect cash as well. The next statement we look at is the balance sheet. From there, we can quickly see how much cash do we have on hand. We see on the asset side, those are all the things that we own. Those are things that we can turn into cash if we need to, right? Or should be turning into cash in the near future. If they're current, such as accounts receivable, we expect to get that money in the near future. And plant and equipment, that would be more long-term, but if we had to sell something, we could in order to generate more cash. And then on the liability side, we see our current liabilities, which are funds or obligations that are due within the next 1 year, and our longer term over 1 year liabilities. One thing we do in generally accepted accounting principles is we always put the current portion of long-term debt separate from the longer term portion. So if I have a 5-year auto loan, all my payments due for the next 1 year on that loan will be up in the current liability section, and the other 4 years worth of debt will be in the long-term section. Why do I do that? Well, I want to know what my obligations are in the next 1 year. What do I have coming up? So on this balance sheet, it says I have $1.3 million of current liabilities. These are things that are due in a year. The current portion of my long-term debt, any payables I have to vendors, anything I owe my employees, a line of credit with the bank. Those are always a 1-year renewal, the line of credits. So I owe $1.3 million in the next 1 year. And then I look at my current assets and I say, do I have enough current assets, either currently cash or turning into cash within the next year, to cover those current liabilities? And yes, indeed, this actually has a current ratio of 2 to 1. 2.6 million divided by 1.3 million is our current ratio. And that's one of the KPIs that we'll talk about in a second that we can use to give us a heads up. Hey, it looks like this company is pretty solid on cash for the next 1 year period. We can also look at our total liabilities as compared to all our other liabilities and our stockholders' equity, which is really just our book equity balance, not necessarily what the company is worth at any point in time. Oops, did we miss one? There we go. Statement of cash flows. This is going to tell us what happened to cash. So the statement of cash flows using the indirect method we'll start out with our net income or loss from that income statement. Usually we do use the line before taxes. But if you look at the net income or loss before tax and then the tax line, those two numbers, if I back up for just a second, equal the year-to-date actual 1,019,850 at the bottom of that net income. So that's the number we're starting out with, the net income before tax less our taxes. That is on the cash flow statement. This first section of the cash flow statement says, did our operations generate cash for the period or use cash for the period? Now, if you're using something like QuickBooks, QuickBooks gives you a pretty good general idea on the cash flow report it has, but it is definitely not in GAAP format. And this is the GAAP format that you're seeing here. So, for instance, we have changes in assets and liabilities after we have the income statement items of net income taxes, and then we add back depreciation. Why do we add back depreciation? Because it doesn't take cash. We paid for that equipment earlier on, we're just depreciating it every year. Our changes in assets and liabilities are all off of our current section of our balance sheet. So when accounts receivable goes down, it provides more cash to us. So in this case, we had a decrease in accounts receivable between the 2 years, and we were provided with $475,000 of additional cash. Conversely, we used or increased our inventory balances by $75,000. So that was a use of cash. You know, and I always say that the hardest job in a company is purchasing, because if you have too much inventory on hand, we're tying up our cash balances and cash is not available. If we have too little inventory on hand, we may have lost sales, which can also affect cash. So that's a very difficult job, a balancing act. Changes in prepaid expenses, things like prepaid insurance, deposits, accounts payable, right? If we decrease the amount we owe people, we've used cash in order to do that. So that's a big use of cash right there. And same thing with any accruals of salaries and wages that we owe our employees that we've paid. So in this example, this company has provided $1.2 million from operations. And it says, what else did we do with that cash? The next section is investing. And this is investments of property and equipment. So did we buy any more assets on our balance sheet? This section would also show any reductions for sales of assets. And then the last section is the cash flow from financing activity. Changes in equity would represent new investments or dividends and distributions made to owners. And then any changes in debts, any new debt that you received or any repayments of debt. And in this company, they had repayments of $350,000. So we take our P&L numbers, our net income numbers, we adjust for the changes in current assets and liabilities and non-cash items. We show how much cash is provided by operating activities. Then we say, did we spend any on assets and what happened through financing and owner's equity. That shows us our net increase or decrease in cash for the period. We add that to the beginning of period cash to find out our ending period. So even though we made $1 million on the P&L, our cash balance at the end of December here is only $730,000. So this statement actually gives you the details of what happened between profit and cash. So what is relevant versus irrelevant? We get bombarded with so much information. We can run so many statements and so many metrics. What do we need? I really like this quote from Dan Baum. The way he talks about metrics is that they really enable us to view our business objectively, right? If we set some standards and some goals up front, and we set some achievable, specific goals that we can measure something for, we're not going to get blinded by emotion, as he says here. It's really, you know, a boss a long time ago said to me, there's a difference between knowing and knowing. That sounds silly, but it sort of made a lot of sense over the years to me. So we want to be able to objectively look at our business. We can have financial and non-financial KPIs or key performance indicators. For example, how about acquisition of customers? Do we know what it costs to acquire a customer? Do we know what the average sales revenue is for our customer? How do we know if our customers are satisfied? How do we monitor customer retention? How do we know if our sales are profitable? So key performance indicators are telling us whether we're on target to meet our results and give us early warning signs. Some of my favorite financial KPIs are, of course, gross profit, telling us if we're profitable on sales and what that trend's doing. It's really important to watch that trend on gross profit. Days sales outstanding. If you provide terms to your customers, an easy way to monitor how your collections team is doing, whether that's you or a herd of accounts receivable clerks, it tells you on average how long does it take to collect your receivables. So if you give your customers an average of 30 days to pay you and your days sales outstanding is 42 days, somebody's got to get on the horn and start bugging these people to pay you. You're losing 12 days of cash flow there. If your average terms are 30, conversely, and you're collecting in your DSO is 25 days, great, you're doing a good job. But it gives you a very quick way to know, how is my collections team doing? How are we doing on that? Days sales and inventory. How long does it take to sell our inventory on average? If we have inventory on the shelf, again, that represents cash. We want to turn that into cash as quickly as possible. Now that's very dependent on which business you're in. If you sell fast food, I hope that turn is really quick because that food's going to go bad. Whereas maybe if you sell Maseratis, 90 days to sell a car isn't that long. If possible, you want to look up metrics for competitors in your industry. There usually are some publicly traded companies in every industry, so you can look up average days sales and inventory for your segment and say, gee, most people who sell water bottles have days sales and inventory of 48 days. Mine is 32, I'm doing great, right? So it's a nice way to say, and there's lots of information on the internet on how to calculate these numbers. But again, they're all done off trends on your financial statements. So once again, you want those financials to be accurate. The current ratio we already spoke about a little bit. Quick ratio is very similar to it, but it just tells us are we in jeopardy of running out of cash in the short term? And lastly, debt to equity. Are we too leveraged? What does that mean? Well, most bankers, they'll once you get up to $2 or $3 of equity of debt for every $1 of equity, they're getting a little nervous because now you're playing with primarily their money, and they really like owners to have skin in the game and have some equity. So if we get too leveraged, we may have a harder time getting bank debt or any lending debt, and we might be forced then to raise equity, give away ownership if we need to raise additional cash. So what are some cash flow danger zones? That's why we do forecasting. We're trying to figure out what's about to happen, what's out there. So we use forecasting for decision making. And it's going to show how our business reacts to different financial situations. We really want to set up this forecast to be a sensitivity analysis where we can change assumptions and the financial model will tell us what the result is. It can help us find the strengths and weaknesses that maybe we weren't aware of, and people outside of our company can use it to quickly value and analyze our business. And that's using past trends. Our past trends generally need to support our future projections. So if your historical financials show that you typically have a 5% net income every year, and your projections are showing you have a 25% net income, somebody's going to ask you, is that reasonable? What's changing here? Why is it so different than your historical numbers? Really important, a good forecast is based on documented estimates, and you should have different versions with different assumptions. You're kind of stress testing your business. You're showing this range of possible outcomes. I tell people to do a high, best case, a low, worst case, and then maybe a most likely case, and see what's happening with your range of assumptions here. You want to simplify the forecast. You don't have to get too overly detailed with it. You're just looking for answers to how much money do we need, when do we need it, and why do we need it. And we want the process to be repeatable so we can update this forecast. And we want to make sure to forecast both profit and cash because, as we just heard, those things are not the same. So this is a really nice summary of someone who's looking for money. How much? And we're looking for 1.1 to 1.3 million. By when? By June 30th. Why? We're launching a new division in Texas, and we need to fund capital expenditures and first-year operating losses. So we're telling people what we need, by when, for what. So forecast basics, we want to make sure we understand when we're going to be profitable, how long our cash is going to last us, when are we going to need to raise more and how much more, what for. And again, we want to have a best case, most likely case, and worst case scenario. Excel is my favorite forecasting tool. I'm glad to see that a lot of you are using Excel as well as your accounting systems to manage cash. I can't tell you enough to document your assumptions. That is so important. Why? You're going to forget what you assumed sometimes. And also just to make sure it's reasonable. If you show it to someone else, they can look at it and say, well, is it reasonable that you're going to hire 5 more salespeople in the next month? Can you afford to do that? Where's that coming from? Your sales forecasts, when you're making your assumptions, what price are you selling at? What quantity? Do you have different levels of sales that you do? When are you going to sell it? When are you going to get paid for those sales? Expenses can be percent of sales. Some things are like probably your cost of goods sold items. If you have a product, sales commissions are a percent of sales. People forget bank fees a lot on credit card purchases. You know, those can be 3% or more. Payroll, you know, don't forget payroll taxes, work comp insurance. Those are usually also a percent of payroll. So how are you coming up with your expense amounts? Make sure you document them and you understand that. Do you have any debt or investment or capital expenditures coming due? And this is sort of the format. I know this is small, but just to give you an idea, I like to do monthly for the first year and then quarterly out for the next two. And it helps me to do monthly because it's a lot easier to track actual to your forecast and make adjustments as you go forward. You know, we don't know what we don't know. When we create these things, we're making estimates and assumptions. So we want to go back and learn from the actual results so we can get better and better at forecasting. So this would be a service company forecast here, and you can see we are breaking out what we're paid in cash versus credit card versus on account, because that's going to affect our cash flow. So we make assumptions. This is the income statement or P&L. Again, the revenue is in the month it's earned. The expenses are in the month they're used. So I like Excel because we can use formulas and we can link cells together or to other sheets to help us calculate these numbers. And then there's the cash flow projection, which is going to be based on the profit and loss, and this forecast updates your cash flow. But the main difference between the P&L and the cash flow projection is going to be timing. For example, of profit and loss, the insurance will be used monthly. So every month we will expense 1 month worth of insurance, whereas on cash, maybe we pay our insurance once or twice a year. So we want to make sure we put it in the month we're going to pay it. So we can see when are we going to be low on cash or need to have outside funding. In this example, we have March and April are negative months. But then we can see we're positive again in May. So we can say, I need some short-term borrowing ability to make this work. So again, a monthly cash flow that we can then compare. So what's next? Always compare actual to your forecasted and adjust the forecast going forward for what you need. And now I'd like to leave some time for any questions anyone might have.
Okay, fantastic information, Jenny. Really good stuff. I've got a couple of questions. If any of you have any others, feel free to chime in with your question box there, and we'll get to it. The first question is, where can I find financial information on my industry so I can compare my individual results to that?
Great question. Yahoo Finance and Google Finance are both great sources for looking up industry statistics. So I would start with those, but you know, Google's amazing anymore. I can get in there and I can say, what is the average day sales outstanding for the food industry? And it will generally come back and give me some stats.
Great. And the next question has to do with Excel templates for forecasting. You had mentioned those. Where is a good place to find resources for Excel templates for forecasting cash flow?
I actually have a couple I've done for the SBDC, one for service business and one for manufacturing, and I'd be happy to send those to you, Kelly, or through the survey somehow if anybody wants to grab those. Otherwise, you can look online, and again, Google look from. A lot of them are paid models. Forecasting in Excel, it's good to start with a model, but you'll always want to modify it for your own unique situation. Every business is different. Every business is going to have some different needs in what they put in their forecast.
Fantastic, and we're getting quite a bit of response from individuals that would love to see those, so thank you very much for sharing those with us. A question that just came in, and I haven't read this yet, so It's a real estate sales company with no inventory to account for commissions and cost of goods sold. Do you have a model for that, or do you use a different approach?
Um, if you're a service business, you do not have cost of goods sold. So you would always, it would be down in operating expenses. So any sales commissions, you would just go ahead and put down in your general. I'd break up your P&L by your biggest cost in a service company is going to be salaries and commissions and any kind of payroll. I'd start my P&L expense section with the payroll costs and then come down from there as far as what else are your next biggest, in a real estate company it might be facilities costs, for example, and then put all your facilities costs together. So that's most of the accounting systems allow you to have what we call sub-accounts, so you can categorize expenses and not have them all just, again, alphabetical. Using account numbers helps a lot too.
Well, great. Fantastic information. Great job, Jenny. For those of you that would like to view it again, it is going to be on our website and on our YouTube channel at csub.edu with the /SBDC. So that should be up in just a little bit, the recording of today's webinar. Also, for those of you that are looking for capital, either debt or equity funding, to finance a small business growth or for startup capital, the CSUB Bakersfield SBDC will be hosting the Kern Capital Summit next Wednesday on December the 6th on campus at CSUB. You could go to our website and find out more information. It's a little longer than a half-a-day presentation, very reasonably priced, and we'll have about 30 different finance professionals dealing with financing and equity programs. If you can't make it, it's a little too far away for you, excerpts of that will probably show up in future webinars, so keep posted for that. Our webinar series in 2018 is going to go weekly. That is the new announcement that we're coming out with. We're going to have a webinar every single Wednesday, and everybody that will be invited to attend. We'll be looking for topics, so please go to your survey afterwards. And I think that's about all I have. So for Jenny Inholm, I'm Kelly Bearden. Thank you for joining us, and have a very profitable day. Goodbye, everyone.